Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Wednesday, June 7th, 2023. And welcome back to the Crypto Overnighter podcast, where we have no sponsors, no hidden agendas, and no BS. But we do have a contest, so let's talk about that. On the YouTube side of things, if you are a subscriber with a US mailing address, comment on the May 2023 covers video for a chance to win a hardware wallet. Just tell me what your favorite cover for that month is, then you'll be automatically entered to win a new hardware wallet. Which wallet? Well, I'm footing the bill for this one, so we'll see when it comes time to buy. But for now, we've got some news, so let's get to it. And we're starting things off with a bang tonight because the SEC recently launched lawsuits against two of the largest cryptocurrency exchanges, Coinbase and Binance. These legal actions have substantially affected the net worth of Brian Armstrong, the CEO of Coinbase, and Changpeng Zhao, the CEO of Binance. Armstrong's net worth dropped by $289 million, while Zhao's plummeted by $1.33 billion within a 30-hour window after the lawsuits dropped. Despite these losses, both CEOs have seen their net worth grow significantly over the last year, with Armstrong experiencing a 61% increase and Zhao a 106% rebound. However, these lawsuits have caused a ripple effect, leading to 67 cryptocurrencies being classified as securities by the SEC. These lawsuits are not just affecting the companies directly involved, but also have implications for other players in the industry. There are concerns that the SEC's actions could open up opportunities for other jurisdictions like Hong Kong, Dubai, and El Salvador to attract innovation, capital, and talent. This could lead to a significant shift in the global crypto landscape. Countries with more transparent rules and supportive regulatory environments will reap greater rewards. Now, let's dive into the individual cases against these two crypto giants. First up, we have Binance. Now, according to court documents, the SEC has been investigating Binance US since 2020. These filings reveal allegations of profit-making by the crypto exchange amounting to hundreds of millions of dollars. The SEC filed a lawsuit against both Binance US and their global entities. They also filed against Changpeng Zhao, claiming that they operated an unregistered securities exchange that facilitated crypto trading. As a result, the SEC has sought to freeze the assets of Binance US. The SEC investigation was internally initiated on October 17, 2020, at least according to SEC lawyer Colby Steele in a court filing. This inquiry focused on possible violations of federal securities laws by BAM Trading Services Inc., which operates as Binance US. An additional court filing by SEC accountant Sachin Verma stated that BAM Trading generated $411 million in revenue over slightly more than 4 years, during which he calculated a gross profit of $225 million. The SEC's move has become a hurdle for Binance's business operations in South Korea. The Financial Services Committee, or FSC, is South Korea's financial watchdog. They're scrutinizing Binance's acquisition of the local crypto trading firm GoPax. This acquisition happened in February, marking Binance's return to the South Korean crypto market after a 2-year gap. Due to the recent SEC lawsuit, the South Korean government paused GoPax's executive change report. That report was filed on March 7th. It contained details about the nomination of 3 Binance members as inside directors of GoPax, including Leon Sing-Pung, the CEO of Binance Asia Pacific. Binance's acquisition of GoPax aimed at not only re-entering the South Korean market, but also to rejuvenate GoPax, which has been struggling. In November of 2022, GoPax had to halt withdrawals of principal and interest payments from its decentralized finance service GoFi after the collapses of FTX and Genesis. Binance's acquisition promised to inject new capital into the GoPax exchange for customer withdrawals and interest payments for GoFi. And so it came to pass that on Tuesday, the SEC asked a federal court for a temporary restraining order to freeze the U.S. assets of Binance. This move came just a day after U.S. regulators announced their suits against Binance and CZ for allegedly operating a web of deception. The SEC accused Binance of years of violative conduct, including disregard for U.S. laws and evasion of regulatory oversight. Binance's holding company is based in the Cayman Islands. Binance US is its US affiliate. Binance said the SEC's motion only concerned Binance US. Following the SEC's motion, Binance US reassured its users that their assets would remain safe and that the platform would maintain standard deposit and withdrawal operations. Binance US also stated that it would defend itself in court. They labeled the SEC's actions as unwarranted. The SEC alleged that Binance manipulated its trading volume, diverted customer funds, failed to prevent U.S. customers from using its platform, and misled investors about its market surveillance controls. Binance is also facing legal action by the Commodity Futures Trading Commission, the CFTC, and the Justice Department. Now, while Binance deals with its issues, Coinbase is also under the SEC scrutiny. The United States Court of Appeals for the Third Circuit has asked the SEC to clarify its stance on a rulemaking petition submitted by Coinbase. Coinbase filed this petition in April as an Administrative Procedure Act challenge. They asked the court to compel the SEC to respond to its 2022 request for formal rulemaking in the digital assets sector. Coinbase argued that the current regulations are not well suited for digital assets. Coinbase is in the midst of a legal battle with the SEC. The SEC has been given a deadline of 7 days to specify whether it plans to deny Coinbase's request and to provide reasons for such a decision or to outline when it expects to make that decision. Amidst these proceedings, the SEC also filed a lawsuit against Coinbase. As we discussed last night, they allege the company is operating an unregistered securities exchange. In response to these events, Paul Grewal, Coinbase's chief legal officer, stated that they initially petitioned the SEC for rulemaking nearly a year ago. They did so because they believe that regulation should precede enforcement actions. He also questioned the SEC's intentions, stating that they suspect the SEC had decided to deny their petition for rulemaking, which is why they believe the SEC is proceeding with litigation against them. The SEC has also been asked to explain why the court should not maintain oversight of the case and why the SEC should not provide Coinbase with regular updates on rulemaking as requested. On the other hand, Brian Armstrong responded to the SEC lawsuit in a public tweet. He expressed his confidence in their facts and the law and welcomed the opportunity to gain some clarity on cryptocurrency rules in court. The SEC's lawsuit was filed on June 6th. In part, it alleges that Coinbase has been operating as a securities exchange, broker dealership, and clearinghouse without registering with the commission. The SEC argues that 13 different cryptocurrencies sold by Coinbase qualify as securities. In his response, Armstrong emphasized that their case is unique because it focuses solely on the definition of security. He also highlighted the lack of consensus within the U.S. government on which cryptocurrencies are considered securities. Armstrong is hopeful that these court proceedings will provide crypto exchanges with clarity on how to comply with securities laws. He also praised recent efforts by the U.S. Congress to enact cryptocurrency legislation. The exchange previously received a Wells notice from the SEC on March 22nd indicating potential enforcement actions. Potential that the SEC certainly lived up to. Foolishly or not, remains to be seen. Now, Coinbase issued a statement on April 19th disputing the SEC's potential enforcement as not being supported by law or within the Commission's authority. Following this, Coinbase's team took a proactive approach on April 25th by filing a lawsuit against the SEC. This lawsuit claimed that the SEC failed to provide clear rules for crypto exchanges in a timely manner, particularly rules that differentiate between cryptocurrencies that are or are not securities. The SEC responded to this by arguing for dismissal on May 25th, and Coinbase submitted a mandamus reply supporting its lawsuit against the SEC on May 23rd. Due to these legal actions, the SEC and Coinbase are now engaged in two separate legal proceedings against each other. Now, while these two giants are battling the SEC, let's shift our focus to the international scene. In a notable development in the digital payment industry, Circle Singapore has successfully obtained its major payment institution license for digital payment token services. The license now permits Circle Singapore to offer a range of services in the city-state. These services include digital payment token services, cross-border money transfer services, and domestic money transfer services. The firm made this announcement on Wednesday. Now, it's important to note that Circle Singapore is an affiliate of Circle International Financial, and the latter is recognized as the issuer of USDC. USDC holds the position of the second highest stablecoin by market cap. Last year, the Monetary Authority proposed rules concerning stablecoins. These rules set specific capital and reserve requirements for issuers. Additionally, they aim to prevent users from engaging in activities such as lending and staking, which typically allows users to lock their crypto up to earn interest. This move marks a significant step for Circle Singapore in its endeavor to expand its digital payment services, further validating the growing acceptance and regulation of stablecoins in the financial markets. As we see the crypto industry making strides in Singapore, back home, the U.S. Treasury Secretary and Congress are pushing for more crypto rules. U.S. Treasury Secretary Janet Yellen recently called for additional regulation for cryptocurrencies, pointing out that there are gaps in the system that further rules could address. This comes as part of her ongoing push for increased oversight in the cryptocurrency sector. Meanwhile, the U.S. House of Representatives Ag Committee held a hearing on digital asset regulation on June 6th. This hearing was a lengthy one. It included testimony from the current chair of the CFTC, Rostin Behnam. Also participating were some former regulators and Coinbase's Paul Grewal. The hearing mainly focused on a draft bill authored by Committee Chair Glenn Thompson and House Financial Services Committee Chair Patrick McHenry. And I just want to take a minute here to point out how rare it is for one bill to be pushed by two separate committee heads. It's rare that that much influence is put behind anything other than big impact marquee legislations. Now, according to Thompson, this bill was presented with the hope of being a bipartisan joint committee legislative proposal. However, Democratic committee members expressed concerns about the complexity of the 162-page bill, which they had only been allowed to see the previous week. Thompson emphasized that this bill was still a draft, but argued that it was necessary due to gaps in current federal laws and regulations. These gaps have led to complicated enforcement actions by regulators, causing confusion in the industry and the market. The bill aims to cover these gaps, particularly in the spot market for digital assets that are not considered securities. This lack of regulation has led to situations such as everyday people selling cryptocurrencies in unregulated settings. Meanwhile, bankers are avoiding cryptocurrency due to its unregulated status. The bill proposed by Thompson and McHenry would alter the method of defining securities and commodities based on how the asset is traded and the level of decentralization. It also aims to create new definitions of digital commodity brokers and dealers without changing the fundamental components of market structure. According to Behnam, the proposed changes would impact about 60% of the digital assets market. This primarily refers to the markets for Bitcoin and Ether. Behnam identified them as commodities rather than securities. However, Behnam expressed concern about the bill's provision for a temporary registration period, which would temporarily relieve the bill's requirements while the final rules are being drafted. This bill would significantly expand the CFTC's role in the digital asset regulation, but funding for these new responsibilities is contentious. This bill does not include a funding mechanism, a point several Democratic committee members raised, while the House Appropriations Committee proposed rules for reducing the CFTC's funding. I tell you, having watched the government a long time, putting forward a big bill like this without a funding source isn't all that uncommon, actually. It's just a move to get it on the books now and figure it out later. They'll come back and say, oh, this bill we just passed needs funding. Who knew? And then slice off funding for the project. Behnam revealed that the CFTC would require an additional $120 million over the next 3 years to implement the bill. This funding would be used to create 3 rulemaking teams and to upgrade computer hardware and software. While the future of this digital assets regulatory bill remains uncertain, it is clear that debates and discussions around crypto regulations will continue in Congress. The proposed legislation and Secretary Yellen's comments are just the latest indicators of the ongoing efforts to bring more regulation and oversight to the burgeoning crypto industry. As we wrap up tonight's show, let's take a moment to reflect on the impact of these developments on the crypto industry. The SEC's crackdown on exchanges can exert downward pressure on the prices of crypto stocks, altcoins, and the valuations of crypto startups based in the US. In the longer term, these lawsuits could lead to exchanges being more cautious when dealing with US customers and providing access to what the SEC claims to be securities. Critics argue that the SEC should focus on safeguarding investors through clear regulations rather than enforcement actions. They believe the SEC's current approach is driven by personal ambitions rather than the Commission's core mandate. Some would even describe the SEC's actions as lazy, as it fails to push proper regulation forward. This lack of clarity and guidance from the SEC has been deemed unfair to the crypto community. They have concerns that the SEC is regulating through the courts rather than offering clear guidelines. Those critics are what I would call absolutely correct. The legal actions serve as a reminder of the urgent need for clear regulatory guidelines in the rapidly evolving world of crypto. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And if you're watching on YouTube, go ahead and enter this month's contest. And in the meantime, we'll see you tomorrow night.